Hello, Maverick traders. Welcome back to your currency midweek for September 14th. Corey here with you. Nice to see all of you as well. A quick reminder to make sure you follow your trading plan. So let's get to a review of what's happening so far this week. Let's go through these things a little bit because there's not a lot of changes from last week to this week. So what happened? Remember that these are monthly numbers that come in. So this is the US CPI month over month, and it was a little bit more than expected. It was expected that it would drop by 0.1. It rose by 0.1. But this was the bigger issue. Core CPI was expected to be up 0.3. It was up 0.6. Now, core CPI is inflation minus food and energy. And why is that important? Well, those are the things that hadn't been as inflationary as food and energy, and yet they're now on the upswing. So while food and energy, flattens out, now it's all the other elements starting to peak. And if we look at the charts, I think these charts, the actual graphs themselves are telling. You can see that the regular CPI number at 0.1 is not too big a deal, and certainly off of the peak where we were hitting over 1% month over month growth, right? That was when inflation had kind of peaked out. Well, now it's hitting a lower level, but look at this graph of core CPI. You're going to see that it's staying up there. So it actually is still up here at over 0.5% month over month. And this was anticipated to fall back in here and even trend lower. And this sent the markets in, roiled the markets, and the markets went crazy yesterday. And we saw equities down 4% in the major indexes and so on. And this is really the story. There are certain times in your life when certain things are most important. Sometimes it's jobs. Sometimes everyone's focused on the jobs numbers and the jobs data and so on. Other times it's inflation. We used to ignore inflation for many years because it just wasn't impactful. I mean, look at it. It was down here for years and years and years. There was nothing here in 2015, 2016, 17, 18, 19. What were you worried about in terms of the inflation number? It was just down there at those same levels and not a concern. That has shifted, that has changed. The Fed should have saw it. I just don't understand the Fed. When inflation spiked like this, that's a warning sign. That is, hey, something out of the ordinary. And they came out arguing, well, it's a transitory. And then it spiked a second time. And they have no excuses. And once again, what was their message? Oh, it's transitory. And they lost it. They lost control of inflation, and you can see the effects of that now. It was a huge issue that the Fed got wrong. And this is why it matters, is because remember how impactful the Fed is towards asset prices in general. I've been trading for 2 decades, over 2 decades now. When you're trading for 20 years, you come to learn what really matters, and the Fed matters. Central banks matter to how these things move because, all of these programs, quantitative easing, quantitative tightening, we're talking about literally trillions of dollars on their balance sheet. These move markets, they move interest rates, they change economic activity, and when they make a huge policy error, it has lasting impact. And so this is why, I think we're still in this bear market. It's still a longer run issue. And the reason for that is because for the foreseeable future, the Fed's just going to have to keep fighting inflation. And that's going to continue to really hurt the economy. When you look at, here's another important point. If I go to the stlouisfed.org and look at the 10-year minus 2-year, what is this? Well, this is the yield that a 10-year bond pays minus the yield that a 2-year bond pays. Now, think about how bonds work. You should be compensated for lending someone your money for more time, right? If somebody said, hey, I want to borrow something for a week, you would charge them X amount. If they wanted to borrow it for a year, you'd probably charge a little higher rate, right? The same thing happens with mortgages. If you take out a 15-year mortgage, you expect your interest rate to be lower than if you would take out a 30-year mortgage, right? The longer duration usually has a higher yield. Sometimes that goes backwards. Sometimes that gets inverse, right? Inverted yield curve, meaning that a 2-year now has a higher interest rate than a 10-year. So I can put my money in a 2-year and get paid more than in a 10-year. That's odd behavior. Look at the history of this. Let's go back as far as this chart will go. And you can see all the times that we got an inverted yield curve where it dipped below this level, right? And we can look at those scenarios. And what do you notice in each of those? Do you see the shaded area that came later? It usually is about a year later. This is certainly a leading indicator. A leading indicator meaning it goes inverted before you hit recessions. That takes the economy a while before you start printing negative GDP numbers and so on. But the shaded areas represent recessions. We hit a recession after an inverted yield curve. We hit a recession after the yield curve went inverted. We hit a recession after the yield curve inverted. We hit a recession after. We hit a recession after. We hit a recession after. And right now, we're in the inverted yield curve. So what do I think is going to happen out here down the road? Well, it's going to be a gray area. It's going to be a recession. I think that's highly likely. So there's still this debate and this argument. Are we not? Are we, yeah, I think there's the odds of us going into an economic recession or already starting to show the numbers that are in an economic recession. I mean, it's here, it's coming, that sort of idea. So, that's my takeaway. I know it doesn't paint a super rosy picture, but that's kind of, the driving forces, and the Fed has to fight this inflation fight. That is the battle that they're stuck with at this point in time. And let's talk about a few other things that are happening here in the market as well. So for this week's performance, I mean, you can kind of see in terms of the price action for the markets, pretty ugly week thus far. Equity markets down about 3%, crypto down 7%. The only thing that's up is oil, and energy just continues to be a better performer, an outperformer, although it has suffered a little bit lately. It's not, booming higher, it's staying up more stubbornly. We'll look at some of these charts, but the market has been in this trading range here in equities. We'll look at currency land, which has certainly gone risk off, and crypto. I mean, so far this week, it's a risk off week, right? So let's look at this S&P chart. And I kind of spoke to that before we pulled up the chart, but I think this is the key level. If you just drag your trend line up here, and I'm just kind of eyeballing it, and there's a trend line down here, these are basically this is your range, this is your symmetrical triangle, all the moving averages bunched together and somewhat sideways. We've been in this range, right, since we hit this low. We've been establishing a little bit higher lows. When we hit the highs, we're still below, and we're still in this long-term bear market. So where do we go out of this? Well, probably this way. But it's a question of more when. Do I think we're going to break the uptrend line and have more selling and such? Yes, I do. And I think it's probably coming sooner rather than later. I wouldn't anticipate a big, recovery in the market to go screaming higher. I don't think that's coming. Could you bounce here for a couple of days before you drop? Sure, absolutely. But I think the break of that trend line is coming, which would really be confirmation that we're out of the range. So watch for that. Even with yesterday's selling, I couldn't get too aggressively bearish. I did enter, some bearish, expectations of equities going lower yesterday, which is working out a little bit today. But ultimately, I didn't want to punch the gas too much. I think we need to see that trend line break, and then I can feel pretty confident that we're headed back towards those lows and even lower, quite possibly, than that. Now, as we look at FX, it makes sense that you'd have more of a risk-off dynamic in play here, where your three defensive currencies, the yen, the US dollar, and the Swiss franc, are the strongest, or at least in that category. And then the weaker components, your commodity currencies here, especially New Zealand, the Kiwi there, not trading well at all. Crypto land, we're in a bear market, and it's just heavy. Whenever it tries to rally, people sell. It just can't seem to get out of its own way. Last week we had a nice bounce, and then this week just more selling, more selling. So it's kind of been in that process and not really broken out of the range. Again, my instinct would be, and I've said this for a few weeks, I just really think that out of this consolidation, you're likely to see lower prices in crypto. It'd be nice if it was the bottom and everybody, kind of it boomed and people recovered in their crypto investments or whatever. I'm just not so sure that that's going to transpire. I would lean towards thinking that that has more downside to go. Now, as we look at these things a little bit more closely, you still have to kind of have, in the short run, I'd call us bearish, but, maybe we bounce a little bit for a day or two. If you gave me a couple of weeks, I'd feel better and more confident that we are going to have that breakdown. Now, as we look at other markets, pretty much the same picture. I mean, here you have international equities. It's a similar overall chart pattern, and ultimately probably going to break lower. If we look at crypto, it's just been in this, I don't even know what you'd call it, maybe a low base, maybe just a trading range, whatever it is, from where it kind of collapsed down to these prices back in June. It's just gone sideways for months on end. I mean, that is about as sideways as you can get in crypto. It hasn't, there haven't been too many periods where it's just gone sideways like that for months on end. So that is a change in its behavior. Certainly we went from extreme high volatility to a low volatility phase. At some point, the low volatility will, transition back to a higher volatility phase. We'll see when that starts to happen. Let's look at the rest of the calendar this week. So PPI came out this morning here in the US, met expectations. Core PPI a little bit up, as you can see there. Tonight, let's actually talk about, in Australia, they have employment out tonight. So if you're trading the Aussie, be aware of that. Tomorrow morning, we get retail sales here in the US. And then on Friday, you get some retail sales in the UK and consumer confidence. The consumer confidence numbers have been interesting. Why are they expected to go up? What's the expectation that the consumer is going to feel better? Interestingly enough, the correlation here is pretty tight in terms of an inverse correlation. When oil has gone down, specifically gas prices, consumer sentiment has gone up. When gas prices are rising, consumer sentiment has gone down. And it's a pretty interesting relationship. Now, I'm not sure why the consumer only cares about gas prices, but that seems to be their focus. And right now, gas prices are and have been trending lower. So, yeah, frankly, it makes sense that consumer confidence would bounce back a little bit. Remember, it hit multi-decade lows. Like the consumer confidence readings were, the numbers were as bad as they could ever have seen in decades. And it also kind of it speaks to a little bit of extremist sentiment that happens in the markets. I don't know if this is because of social media and those sorts of things, but we see a lot more extreme sentiment where people feel, great or lousy and those sorts of things where, or at least they kind of speak to that effect that, oh, it's so terrible or it's so great. And there's no middle ground. It's like people kind of feel like they're at their highest highs and lowest lows or something, that we're getting more extreme sentiment readings than ever before, which is, I guess, kind of interesting and maybe not a good thing. I don't know. Let's take a look at a few charts here. So one currency that kind of looked interesting to me, let's go to the pound. And actually, I wanted to look at pound Aussie. And I'm going to start here. The main thing that was kind of interesting to me about this was just the Bollinger Band concept that I trade is when you're below the 50 period moving average, and this happens to be the 50-day, when you're below the 50, if you hit the upper Bollinger Band, that oftentimes leads to a good sell signal, that we're going to have another leg to the downside. And frankly, it fits with the chart setup. Have you been making lower highs and lower lows and been in this downward channel? Yes. So today is the day where it hit there. Now, we've come off of the highs. I mean, it has all those characteristics that you kind of look for that should make for a good setup. So pound Aussie on the short side. And now let's come into a little bit shorter time periods, and you'll see, okay, we got a big bearish engulfing up here and kind of a maybe false move. And if this is indeed a false move, you often get fast moves. That would be further, kind of, hey, this looks like a short. So it looks like a short on the daily, and then the 4 hour looks like a nasty reversal. The 1 hour is not there yet, and that's because we've rallied, obviously. So the short-term charts haven't reversed yet. I think it makes sense to get confirmation that this is a false breakdown. So what am I looking for? Probably won't short this yet, but let's draw up a picture. Imagine it bounces and then it kind of sells off and so forth. And these moving averages come up underneath and you pierce it. And maybe you come up underneath those again. If I can get short on a little small bounce, maybe underneath some of these key moving averages and underneath this area, which would confirm kind of that false breakout signal that we talked about, that would be my preference. So I'm envisioning a scenario where in the next day or two, you further break down, you clearly are not holding above 171, and then you get a bounce maybe underneath some moving averages that gives you a short setup. Okay? And I'll be watching it, kind of on a day-to-day basis, on a multi, on an hour-to-hour basis potentially as it gets closer to that. But I don't think it's imminent. Again, I'm not going to short it here in the next hour or two. Could I get short at some point tomorrow, Friday, something like that? Absolutely. And I think you could trade that to the downside for, a handful of days, couple of weeks even, where it looks like it's poised to continue to have some selling pressure. We had a request for pound CAD. So let's go back to this one on the same type of look where it's daily and then come into some of the shorter time periods. Again, I still think pound looks like a short, just like against the Aussie, which Aussie's not been good, right? We're playing a little bit of a reversal there, but it's still in the downtrend for all those reasons. Well, pound CAD still looks like a short, right? Has pound been better than CAD over the past couple of days? Yes. Well, we've kind of come up to this prior breakdown zone. We're right at that 20 period moving average declining. This is exactly where it should stall out. Then we look at it on a little shorter time frame, go to a 4-hour, and not there yet, but you can see this little relief bounce, and probably the 1 hour isn't quite there yet either, and it's not. So trading it on the shorter term scale, I think you got to wait, and that speaks to this candle. I mean, you're probably not going to get short yet because it's still going up, right? It's still a green candle, but as we start to fail at this level and roll over, that 4-hour chart, that 1-hour chart will turn into downtrends, and then I think away you go. So it's a wait and see. It's not really an urgent action here. What is the time period when the percentage is below zero in months before recessions occur? So it's usually about a year is by definition the first time the yield curve goes inverted. It's about a year away from that point. And so if we go back to that chart and really highlight the first time it pierced, so let's take a look. The first time it pierced and went negative, it would be about a year after that. And the first time it pierced and went negative, let's zoom into this chart, was actually is that April? Let's see if we can get a more exact date. I mean, it probably pierced April 1st, late March. Let's call it April 1st. So the idea here would be that, in the spring of 2023, is probably when you'd start to see that we're confirmed in a recession, that you'd actually see the shaded area. Now, having said that, it's far from perfect. Like, would you think that it's going to land perfectly one year? No. It's like it'll happen maybe in January or April or, August or whatever. It's not going to be exactly a year, but that's around roughly how long it takes. Now, why is that important? It's important because when you first pierce, that doesn't mean you just go, oh, all hell's going to break loose. I mean, oftentimes the economic data is still okay. People are still battling it out. Stocks can still go up, right? But it's a leading indicator to tell you, okay, is a bear market coming? Yes, very likely. Even before that pierced, we probably knew that some form of a bear market was coming or already here. But think about how this helps you. So let's go back and think about this in terms of, why did the yield curve invert before COVID ever hit? Why? How did it know? Like, what was happening there? I don't know. I don't know that it knew anything about COVID or anything related to COVID. It's for other reasons, but I think this recession was probably coming with or without COVID. Do you get what I'm saying? And actually, COVID caused this recession to be super short because of what the Fed did and what governments did. Even though there was COVID, the governments basically printed money nonstop. If you look at the Fed balance sheet, it exploded. Debt went up by trillions and trillions of dollars. They were sending out checks. They were doing this. I mean, PPP loans, all these sorts of things. Well, again, it made the recession, it basically printed over the problem, made the recession very short. But I think a recession was coming with or without COVID. That would be the point. Okay, if you go back further, yield curve inverts back here in 2006, and we didn't get the actual recession until 2007, probably a year and I guess that would be about a year and a half later is when we were actually in the recession, the global financial crisis. Well, if you had started playing a little more defense in 2007 in the anticipation that some form of a recession was going to come, was that helpful to you? Was that good information to know. Absolutely, right? If you could play defense in 2007, what a benefit. You go back to the tech bubble and so forth. If you started to play defense back here in 2021 or something, prior to the actual, or even 2020, because the recession was in 2001, if you started playing defense in 2000, about a year before, what a help back before and in the tech bubble, that was in the early 2000s. So having some idea that this is a precursor to recessions and to risk and those sorts of things can be helpful. And again, it's all related to the Fed and to a lot of what they do. They drive risk taking. They're not the only factor, but they're certainly the largest factor for influencing asset prices over the past number of decades. So very, very impactful. All right, we had another request here. Let's take a look. We had Euro against the US dollar. So Euro USD, this thing continues to be, here's a bearish Bollinger Band setup, right, on the daily chart. And sure enough, that was right before, well, actually, that was after you had pierced parity back here, pierced one. Then it kind of rallied for a few weeks, and then we had another big decline. It's not perfectly at the bearish Bollinger Band criteria, but pretty close. And ultimately, kind of basing here around parity, around 1. You can basically trade $1 for €1. It's trading at even value, which has not been the case, and so in terms of what that speaks to, it speaks to a lot of issues that are happening in Europe. A lot of those issues are energy related and so forth. And without any other opinion or whatnot, I would just have to continue to think it's probably going lower out of here. It just hasn't shown any real ability to go up. And so until this trend reverses, until some momentum really changes or you see a flush out, this back here was a good time to play for a bounce because you had kind of a more classic exhaustion. You pushed through that level that everyone was watching for, and kind of anyone that was willing to sell kind of panic sold into that and so on. What they call a capitulation, where people just throw up their hands, throw in the towel, and say enough's enough. I can't take it anymore, and they just dump their Euro USD longs. And that's what you're looking for a bottom. Is basically the final sellers are pushed to their breaking point. At that point, nobody's left to sell. Everyone that's willing to sell is sold. They capitulated and it's done. And so you get some relief rally. That's about all it's mustered, is a relief bounce. And now we still continue to trade down at these levels. All right. Well, let's come back here. So in terms of the rest of this week, we have a video on trading multiple currencies coming out tomorrow. We have the recap that comes out on Thursdays. And then, of course, we'll have our FX currency trading room coming out this weekend. Always remember to trade proper position sizes. Look for things that are moving, have energy, or trading in the right trends and right momentum, and then look to act upon those. Hope you've enjoyed today's midweek. We'll have some more updates as the week goes on. We'll see you next time. Goodbye, everyone.